The S&P 500 has been on a tear in 2024, up over 20% so far this year. And while there may be some speed bumps in store for stocks before the end of the year, our next guest is staying optimistic on the S&P 500 in 2025. Piper Sandler Managing Director and Chief Market Technician Craig Johnson joins us now to discuss. Craig, 2025 S&P 500 target of 6,600. Just lay out the base case for us here. What are you looking at when it comes behind that target?
Yeah, thanks, Josh. Thanks for having me on the show. I think the base case format is really that this bull market that started off of the lows back in October of 22 is still fairly young at about 500, a little over 500 trading days. The median length of time that most bull markets have lasted have been around 979 days. And if we step back and just think about not only the length of these bull markets, we think about the Fed has now been lowering rates. We think about the yield curve normalizing. We think about the market broadening out, financials really starting to improve. And the fact that this bull market has also been led by more than just the Mag 7 stocks sort of is a positive indication to me that it probably has more room to run, Josh.
Craig, it's Julie here. One phrase sort of made me giggle in your report, I have to admit, where you said, our research shows that new highs often lead to more highs. Things are going higher because they're going higher. I mean, but obviously there's history and there's data behind that. How does that phenomenon sort of work?
So when we've gone back in time, we found that really the only way to change sort of a pessimistic mood on Wall Street is ultimately through new highs. And when we've gone back in the past and sort of looked at when you get 5 new highs, 10 new highs, 20 new highs, it seems to just keep progressing. And it sort of becomes a market where people start to chase it. And then I think more importantly, look at the composition of this market, how it has changed over the years. I mean, I don't think a lot of investors really realize that about half of all the equity dollars at this point in time are basically in ETFs. And therefore, I haven't found a single person that says, I'm buying this ETF because it's cheap. So it's become more of a factor, momentum, and sort of technical driven market that I think a lot of investors really haven't paid attention to. And hence, really, more highs lead to more highs.
Craig, you highlight the SMID cap space here, and you say you think that's going to outperform mega caps, I believe, over the next year. What's the case for that, for SMIDs to start participating more in this rally and leading?
Yeah. So, Josh, what has been sort of leadership off of the lows of October 12th of 22 has really been technology. About 30% of the top 50 best performing stocks off of those lows have been technology. 28% for the S&P 500, that is overall, have been industrials. And when we go through and we actually look at what has led off the lows, it's interesting that from the analysis that we've done, only 2 of the Mag 7 stocks have been among those 50 best performing stocks. And so you go through and you start doing the analysis and you say, the S&P was up 62.6%, but the median stock was up 182.6%. And if you go do the same analysis on the Russell 2000, you'll see that on that particular index, you've got numbers that are almost 2x that, looking at the top 50 best performing stocks.
So, Craig, what's the biggest risk in this whole scenario? What would sort of stop that momentum march higher?
Well, there's a couple things that can slow it down. First and foremost, we've got uncertainty around an election coming up and how quickly the results of this election are known, number one. Number two, what is going to happen on the geopolitical front? I think there's a lot of uncertainty around the Middle East and certainly around Ukraine at this point in time. I think number 3 is the Fed. Has the Fed gone and reduced rates too early? And then we start watching 10-year bond yields move higher in the face of the Fed cutting. That would suggest that perhaps they made a mistake. Any sort of reverse in course from the Fed, which I don't think will be the case, would be some of the things that could certainly slow down year 3 of this bull market.